And what we're doing next is the short run. So here's how the big picture, 30,000 feet level. We're looking at the short run, and then we're looking at the long run. So this grouping of a couple of chapters or a couple of sections deal with the business perspective, okay, as opposed to the individual. You know, in the previous units, we generally looked at the individual, say for the supply side of supply and demand. But this section, this grouping of short and long run, deals with a business perspective. So we're taking it from the point of view of the firm, okay? So it's microeconomics from the point of view of the firm. And essentially what we're trying to do in both of these sections is to say, what is the best production level to operate at? So if we're a firm, what we're talking about is producing items, let's call it widgets, as opposed to a service firm. Let's assume that we're producing widgets. We need to be able to think about it from the point of view of our goal is to maximize our profit. And our goal is to maximize our production in order to increase our profit, or to make our production such that our profit is highest, let's say that. So what we really need to do is focus on that output issue. And really these couple of chapters or couple of sections are really looking at the output issue and what is it in relation to the cost of production. So that's really what this is focused on. It's very theoretical in the sense that the material and the mathematics and the kind of stuff that we'll be doing in here is not something that's readily to you. However, what it does show is it rationalizes why a firm will produce at a certain level and how, if it produces more than that or less than that, it will create some problems in the firm. So all firms really need to find that sweet spot. And again, the theory explains why there is a sweet spot that is the maximum productivity for a firm. So we're going to introduce concepts like productivity, like average costs, average variable costs, average total cost, marginal cost. And we've already seen some of these terms creep into our discussion so far. So that's effectively it from the 30,000 foot level. So in this unit, we're going to understand how and why economists measure costs differently from accountants. That's an interesting one and something that we need to consider in our lives in terms of the decisions we make with regards to jobs or careers, and why, you know, we often hear, particularly in Newfoundland, oh, those rich small business owners. And, you know, well, maybe they are rich, but they really need to be in order to stay in business, okay? And we're going to rationalize that concept. We're going to talk about the critical relationship between productivity and costs, as I just said, the importance of really differentiating between what we call fixed costs and variable costs, and obviously to be able to graph these sorts of things. And when we look at the graph will help explain optimum levels of production, this concept that we were talking about, and increasing productivity, this terminology that we hear beat around in the media a lot. You know, what exactly is that? What does that mean? And what are some of the ways that businesses can attempt to reduce their costs by increasing their productivity? Okay, so if we look at the short run, what does it mean? Well, we saw in the first chapter that there are 4 factors of production: land, labor, capital, and enterprise or entrepreneurship. And each one of those factors are the resources that go in. They're like the ingredients in the recipe. Okay, if you imagine you're making a pie or making a cake, and there are ingredients that go into the cake, well, those are the ingredients that go into our economic model in microeconomics. Land is naturally occurring resources. Labor is physical, usually physical effort or mental effort, some degree of mental effort that goes into making the business successful. Capital is not the money, but the resources that the money buys. So, for example, assets that you see in the business in order for business to make money, you know, tractors, equipment, buildings, these sorts of things that would go into the mix in order to make the business be able to do what it does. And finally, this issue of entrepreneurial, which is really easily confused with labor, but the entrepreneurial component or the enterprise component is really focused on the idea. It's more of the non-physical. What's the word for non-physical? More of the mental aspect to it. Innovation, creative ideas, these sorts of things. That's really what we're talking about when we're talking about enterprise. And we also saw that each of those have what's called a factor cost. So, for example, labor is wages, and if we look at enterprise, it's profit, and if we look at capital, it's a rent for the money in terms of dividends or interest or these sorts of things. And so we really need to look at those. The basic thought is if you're running a business and you're thinking to yourself, okay, land, labor, capital, and enterprise, how fast can I change those? If my business is operating, how fast can I easily change capital? How fast can I easily change land? How fast can I easily change entrepreneurship? How fast can I easily change labor? So generally, what we're going to find is that in the short run, it's almost impossible to change either one of those quickly. They take time to change. So because of that, we generally say in the short run, all of the factors of production are held constant. Okay? Now, that's not exactly true, but the fact is that in order to be able to assess or define the short run, what we do is we put this basic definition on it that the short run is a period of time in which you really can't change any of the factors of production. It's just, they're pretty well stationary. And what we tend to do, though, is if as I say, not exactly, if we want to be able to kind of see the effect of a change, what we normally change is labor. Of the four, the labor one is probably the easiest one to change in a relatively short time. We can hire people or we can lay people off, okay? So normally when we're looking at this for the purposes of explaining it or the purposes of analyzing it, we look at the labor relationship as the one that we kind of adjust. COVID experience has really demonstrated the problems that companies face when the factors of production, land, labor, capital, enterprise, can't be changed very quick. We look at COVID and we look at the airlines, Air Canada, WestJet, doesn't matter which airline you look at. The headline last year was Air Canada flushes models down the proverbial toilet. This was May 2020. This was at the start of the pandemic. I'm just going to play part of this. Why don't you get a sense of how this is really in the real world? It's not just a theoretical foolishness that we're talking about here.
Government to help the Canadian economy during this time of uncertainty tied to COVID-19?
I think the Canadian government is going to have to move to support the airlines, John. You've got the U.S. government already doing so, and I don't think anybody's going to argue that airlines aren't essential industries. You've already seen support through the wage supplement programs for airline employees. I think that's great. And you got to remember, Air Canada alone has 33,000 employees. So I think the next step is going to be government support for the industries, whether it's loan backstops, because what you're seeing right now is Air Canada drawing heavily on its lines of credit. You may see flat out one-time grants, capital infusions into the industry. But it is clear that government support is going to be something that this airline is going to lobby for, and that the government's going to be sympathetic to.
I guess, given how dire the situation is, Calin Rovanescu just outlining it this morning, whether or not this is, something where you can have a very clear return on investment, I don't know what the math tells us on that, Andy. And I would add to that, when we think about bailouts or at least government aid in the aerospace industry in this country, sometimes that becomes a little bit of a political hot potato in Ottawa, given the mixed track record there.
Oh, enormously controversial. Yeah, but no, let's not get around it. The airlines are somewhat regional players. So Quebec, for example, has always supported Transat. Air Canada is also a Montreal-based company. So you get into all sorts of wonderful Canadian tensions. But the industry itself is going to be out cap in hand, and I think government's going to be sympathetic. But the larger issues and Paige was just talking about that, is the steps that Air Canada is taking. You're seeing them now start to retire airplanes. You're seeing them reconfiguring planes. You're seeing a long-term outlook for the industry, frankly, John, that when I was reviewing the Air Canada material this morning, I was surprised at how pessimistic.
Since that time, Air Canada has had a really rough go of it, as WestJet. WestJet had 15,000 employees, of which now they are down to 5,000. Okay, so you imagine 2/3 of your labor force has been laid off. Very difficult time. So the short run really kind of hit hold, or it demonstrated the impact of an inability for a company to make changes in the short run. They talked about here Air Canada had retired airplanes. So, for example, they took planes out of their fleet and grounded them, and they'll never fly again. Older planes, these sorts of things all got pushed out of the fleet. It was just a major, major, major shock. And air travel was down in March 2020. Air travel was down 90%. You know, no one could have ever envisaged that. So obviously, government had to step in and basically prop up the airlines, because they would have all gone bankrupt very quickly. And it happened in Canada, and it happened in the United States, and it happened all over the world, really. So the short run is real, and big changes that occur in the short run can certainly throw a business for a loop. We need to appreciate the factors of production are hard to adjust in the near term. Constraints are all over the place. You can't shut down a factory and suddenly not pay for it anymore. Once you've taken out a mortgage on it, you're going to pay for it. So you're very hard to react to opportunities and threats that can show up. So a cost analysis in the short run is critical for effective business management, because if you know your costs, you can better plan and set level production and price that allows the company to make the most profit possible. So just for the sake of explaining the firm, one of the things that we delve in here too is the types of businesses that are out there. And it doesn't matter the type of business, all of them are going to face the same basic principles: land, labor, capital, enterprise, and the ability to change any of those in the short run. So if we think of a sole proprietorship, that's a mom operation where mom owns the store, mom runs the store, mom is the store. Or a partnership, which is a mom and pop operation. So mom and dad own the store, mom and dad run the store together, they take on the risk, some sort of a partnership arrangement there, that sort of thing. When we talk about a corporation is a separate entity. We've seen that, or if we haven't seen it, maybe you have seen it so far. If you haven't seen it, we'll see it in law after Christmas. We'll talk about some of the we talked about, I got to think where I am in the program now. You guys, second year, we talked about it in law with regards to the corporation, how it's a separate entity, people are shareholders. Again, those types of corporations are very difficult to change because you need shareholders, many people. It takes a long time to get information down, up, and the like. State-owned enterprises, we call them crown corporations in Canada. That's government-owned, so it's owned by you and me. And generally, they're run no different than a corporation. But normally they serve some purpose. Like, for example, the CBC serves the purpose of the nation's broadcaster. Now, with technology and the changes in technology, it's become questionable whether that's as important anymore. And we got not-for-profit organizations. Again, it doesn't matter. If the company is designed to provide some service or some sort of I'll call it a community good, they still face the same factors of production that any other business would face. If we look at the production process, and this is really kind of outlining some of the theory that we're going to look at now in a few minutes. If you look at the production process, it works very simply. It's not rocket science, okay? We have inputs. Now the inputs, if you're into the concrete business, the cement business, sand, gravel, cement, water, machine, labor, those are inputs that go into a cement type business. And, sand, all of it's naturally occurring sand, that is, you didn't have to crush it, or gravel, same thing. That would be considered a land-based resource, but normally it's like it has to be screened or something done with it. So there's an element of capital there. Water would be naturally occurring. Machines would certainly be assets, that would be capital, and labor would be labor. So those would be the factors of production that are exemplified there. They then would get pushed through this what's called production process. We can think of it as a factory, where the sand is mixed with the gravel, cement, and water in order to make cement. So this production process is going, and it requires these inputs of land, labor, capital, and enterprise, and out the other end pops the output, and the output is cement. Okay, so generally that's the type of flow of any business. The black box in the middle is the production process. Coming out of the inputs are costs, and these would be considered our factor payments. Land would be the interest or the dividends, the labor would be wages. These sorts of things would all make up what we call the costs of production. So we have, as individuals, we have this basic process going on when we look at a financial statement for a firm. We can see, for example, in the income statement of a firm, we can see the costs and the revenues recorded. So here, for example, we have in table 6.1, total totes. Total revenue is cash sales. They sold stuff. Okay, so the revenue amounted to $20,000. Their costs, as recorded on the balance sheet and on the income statement, but in their financial records, their costs will be rent, materials, utilities, hired labor, and depreciation. So their total costs, and I've skipped over the word explicit purposely. Their total cost will be $17,200. So they brought in $20,000. They put out $17,200. So for the purposes of accounting, their profit is $2,800. And that's what it would look like on the financial statements for that firm. It would show that that business made a profit. Okay? Now, that scenario, just this far down here, I'm only gone this far down, that scenario is what we find in financial statements. And financial statements only record one type of cost. Those costs are referred to by economists as explicit costs. Explicit costs are the costs that are tangible costs that can be measured by the accounting process. So rent, material supplies, utilities, hard labor, depreciation and equipment on equipment can all be measured by the accounting process. And as a result, we can churn out a profit figure for that business. Economists, however, look at it and say, well, okay, yes, that's understandable, but there are other costs to a business too. And you say, well, what do you mean? What do you mean other costs to a business? What is the accounting model missing? Well, the accounting model often misses opportunity costs. What do we mean by that? Well, if, for example, I'm just going to switch over here now. I'll work back and forth between this. Let's assume that you are a twin, okay? You have a twin, sister, brother, whatever, and you start this business that is described here. This is your business, okay? Tidy Totes, Total Totes. And in order to start that business, so I'm only looking at this side here, in order to start that business, you inherited $96,000, which you invested in the business and started the Tidy Totes business. Now, you put all of that money into the business. Did you receive any interest revenue on it? No, because you had it tied up in the business. So no interest revenue. Your business profit for the year is showing up. Oh, I wrote 2,000. My mistake. 2,800. So your business profit is $2,800 by the account that is laid out there. So $2,800. And really, you didn't earn a salary from the business at all. Okay, now your twin, on the other hand, also inherited $96,000, but is not an entrepreneurial type. And your twin invested $96,000 into a mutual fund. And that mutual fund earned, for the purposes of this example, 10% annual rate of return. That means that $96,000 in the year of operation, the interest revenue that $96,000 earned was $9,600, 10% of $96,000. Now, there was no business to have a profit for the year, so there was no business profit for the year for your twin. But the twin, because the twin was out and about, they had their money stowed away and they're out and about, your twin is working and they make a salary of $30,000. You started a business, your twin went to work for some money. And at the end of the year, you ask yourself, who in the heck is better off? Who in the heck is better off? Well, okay. Well, you made a business profit, as we see over here, of $2,800. That's nice. But the fact of the matter is, you did not make a salary. Your twin did. So you're already $30,000 down in salary. I would call that an opportunity cost, right? You did not make any money. Your twin did. In addition to that, your twin took the $96,000 inheritance that she or he got and generated interest revenue of $9,600 from it. You, nothing. So the question is, who's better off? Under this accounting scenario, I think you would find that your twin is much better off than you. And that would be very discouraging for you because you invested in a business and, the business made a profit. No doubt about it, your business made a profit. But at the end of the day, you're going to say, I'm not as well off as my twin. My twin has done much better. So from an explicit profit perspective, as we've illustrated over here, the business did make money. But in a comparison to your twin, relative to what you could have done, I'll call it you could have done, your twin did it, you could have done much better by going to work and investing the $96,000. So what does that say to small business people? You're foolish to start a business is what it really says, because there's no money in businesses unless you can make enough money in profit. Unless you can make enough money in profit to make up for, one, the lost interest that you could have earned on the invested money. So this business, for example, would have to earn at least $9,600 more. So take the $2,800 profit. It would really have to be $9,600 profit in order to make it equal in terms of that interest component. But further to that, to add insult to injury, you really worked for your business for nothing. You didn't get any return whatsoever. Your twin went out for $30,000. So really, in order to keep you in business, let's say you're discouraged and you look at the numbers and you say, really, in order to keep me in business, I'm going to have to make $39,600 profit in my business. See, which is the last $30,000 that you didn't earn relative to your twin, and the last $9,600 in interest that you didn't earn relative to your twin. So you're really going to need $39,600 in order to say, yeah, I'm willing to stay in business. You're a tad shy of that. So really what accountants are saying is that there are other costs to running a business or other costs to a business that aren't showing up on the financial statements. And that is the foregone revenue that you could have earned with the invested funds and the opportunity or the time that you put into the business. You could have invested in time in something else that you could have received a salary from. So generally, in order to stay in business, you need to make not only a profit, like this $2,800, but you need to make a profit that is enough to keep you in the business. So in this particular instance, you would have to make a profit of $39,600 in order to stay in business. So the implicit costs really refer to the opportunity costs that you forgo by starting a business, okay? So any firm that's out there, regardless, has to make enough money, more than just a accounting profit. It has to make enough money to make it worthwhile for the owners to stay at it. And in order to stay at it, they got to recoup not only the raw costs of running the business, in other words, they got to make a raw profit, an accounting profit in the business, but they have to make enough profit to compensate for their lost salary and the lost opportunity cost of their investment. So that is called an economic profit, which includes implicit as well as explicit costs. Do you follow that? It's a bit of a concept to get your head around, but it helps explain. We talk about small business owners, and we see successful small business owners and say, my gosh, they're making a lot of money. They need to. In order to stay in the business, you have to make enough, not only for an accounting profit, you have to make enough to make it attractive for you to stay in the business to do the next, so that you don't have to go or don't want to go, to do the next available option. The next available option is to go to work for somebody and to take your invested money and invest it somewhere else. So you need to ask yourself, am I making more than enough in my business in order to keep me in this business? And that's where we talk about the economic profit. So we can see this kind of illustrated here a little bit. This is the one that's in your textbook, and it kind of demonstrates that you need a profit that is made up of real honest goodness accounting profit plus enough profit to keep you in business. And that enough profit to keep you in business, these implicit costs, is referred to as the normal profit. And that's a term we're going to see revisited throughout the course. The normal profit is the profit you require in order to stay in business. So it covers off not only the cost of the business, but the opportunity cost to you, the owner of the business, to keep you from going and doing something else. So you can see in this particular example that there was a $7,800 profit, and it is not related to the previous example. So if we look at very simply from an accountant point of view, the profit is $7,800. But really, that has to be made up of two components: an economic profit, how much you can pay the bills of the firm and all the costs of the firm, what's the difference between how much money comes in, how much money goes out, plus the amount of money to keep you in the business. Another concept that you need to be aware of, and I don't know if you've run across this term in managerial accounting yet, but you should have, okay? This is something called a sunk cost. And a sunk cost is one of these terminologies that you should be familiar with in business. It's a term that befuddles people because they don't understand the relevance of it for purposes of decision making. Sunk costs are costs that are spent on purchasing something: a truck, a tractor, a building, an airplane. It doesn't matter, whatever it is. You put money in a Muskrat Falls, it doesn't matter what you buy, that item costs a certain amount of money. At this instant, as you record that, as you look at the cost of that item, you ask yourself, is that item any good to me? And the answer is no, even though you spent a fortune on it. Okay, let's say you go to the store and you buy a pair of jeans that you spend $100 for a pair of jeans. You go put the pair of jeans on and you say, no, I don't like them, I'm never going to wear them. Now, let's say you can't bring them back to the store, okay? You can woe and complain and feel bad that you wasted $100, but the fact of the matter is it makes no impact on your future business decision making. In other words, it's gone, it's spent, leave it alone. It's gone behind. And it should not impact your future decisions. So for you to say, for example, I'm never buying another pair of jeans, that doesn't make any sense, because a decision in the past has no impact on a decision in the future. So sunk costs are absolutely irrelevant to decision making. If you wasted money in the past, that's not going to help you in the future. If we built Muskrat Falls and we find that we can never get any money back for it, that shouldn't tell us don't do any more projects. That should tell us simply be careful doing your next project, or be more careful doing your next project. Once the costs are sunk, they're gone, they're never coming back, it cannot influence our future decisions. And in many businesses, they're reluctant to do things because they wasted money before, they made mistakes before, and they don't make any decisions in the future. They're afraid to make decisions in the future. That's wrong, because sunk costs have no impact on future decisions. So even if a firm has spent $1 million on equipment, if the money has already been spent and the equipment has no real resale value, throwing it away has no cost. I look at my shed, for example. I was thinking about this the weekend as I was cleaning up my shed. The junk that I have in my shed that I paid money for up the Canadian Tire or whatever, really, it's of no value to me nor anyone else. It's broken or whatever. I can't do anything about it. If I throw it on the dump, it's not costing me anything. I've already lost the money. I'm not going to lose any more by throwing it away. So what we're really saying here is that if an asset is a sunk cost, it no longer carries any more opportunity cost. It's not going to hurt if I throw it away. It's not going to impact me. So other examples of sunk costs would be fees paid to a consultant, or money spent in market research, or a prepaid meal that you miss. Once it's gone, it's gone. There's nothing you can do about it. So here's a little test your understanding here that is a good illustration of some of the challenges that most businesses face, okay? Judy is presently working as an activities facilitator at a community center, where she earns $1,000 a month after tax. However, she's not happy with her job and is thinking of returning to college to do a 2-year program to upgrade her skills. She has estimated the costs to be annual cost of tuition and textbooks, $2,800. Annual cost of board and lodging, $8,000, which is the same as her present costs, okay? Annual transportation cost per year, $700. What would be the economist's estimate of her costs of Judy taking the 2-year program? So let's look at it. So if Judy went to school, we're assuming here that she's going to give up her job, okay? Judy is presently working. That means I'm assuming that she will no longer be working if she goes back to school. So the very first opportunity cost that she has, from an economist's point of view, is that she's going to give up her job. That pays $1,000 a month. So if she's gone for 2 years, that's $1,000 a month times 24 months. Right off the bat, going to school is going to cost her $24,000 in opportunity cost, okay? In terms of accounting costs, she's going to have to pay $2,800 in tuition and books and this sort of stuff. That's real money that's going to go out of her pocket. But in terms of the total cost, it's $24,000 in lost salary plus the $2,800 for the tuition. Annual cost of board and lodging. Well, that really shouldn't factor into it because she's going to live somewhere either working or going to school. It really doesn't matter. So the fact is even though at the cost, it really shouldn't play into her decision-making here because she's going to pay that $8,000 out whether she's working or whether she's in school. So that really should not be considered as part of the decision-making criteria here. The additional transportation cost. Now, seeing it's additional transportation cost, meaning that she wouldn't have had that cost otherwise, that would further add to the cost of going to school. So the total cost of going to school would be $24,000, the total economic cost of going to school, $24,000 in lost salary, $2,800 that's annual cost. So $2,800 times 2. What's that? $5,600 in tuition costs. Plus annual transportation costs per year, $700. So that's $1,400 extra cost. So going to school will be quite expensive for them. The trick is, and as you're in school now, the trick is really what you got to think about is, okay, that's the short run. And we're only looking at the short run. But in the long run here, will you make more money? And this is a critical question that everyone has to ask whenever they go to school. Will you make more money when you graduate? The difference between what you can make now with no education versus with an education, the difference between your salary between then and now has to be enough to more than compensate for the total economic cost of going to school. So if it costs you $20,000 a year in school, and you're going to be in school for 5 years, that's $100,000. You would have to make over $100,000 more in salary over your lifetime to make it worthwhile going to school. Now, statistics has proven it doesn't work. You can't make a blanket statement really, but statistically, the more education you have, the better off you'll be in terms of income, and school will pay for itself. And this is a big argument that I see with regards to the students at Memorial now complaining about the tuition costs. Generally, those students are going to receive a salary of probably $20,000 more a year because they went to school. So their tuition, even though tuition is going up at the university and at the college, even though tuition is going up, it will still pay for itself within 2 years of their start of their working career. So the opportunity costs, there is no opportunity cost really to going to school. It will pay for itself. Okay, second one is Abdi recently gave up a job that paid $1,500 a month after tax to open up his own convenience store. He works full-time in the store, which had a total revenue of $105,000 last year. His total explicit costs amounted to $65,000. He reckons his store is now worth $200,000, and if he were to sell it and invest the proceeds in his dad's supermarket, he would earn himself an 8% rate of return. So what is Abby's economic profit for the year? So we'd have to do some math on that. He gave up a job of $1,500 a month. So right off the bat, he needs to make more than $1,500 a month, and that equates $1,500 a month equates to $18,000 a year. So he'd have to make $18,000 a year more in his business in terms of to compensate for the loss of the job. He worked full-time last year, and he reckoned that his revenue was $105 and his explicit cost was $65. So revenue $105, explicit cost $65. So he made an accounting profit of $40,000. Okay, so he made an accounting profit of $40,000 there. Just this far alone, let's just look at this far alone. The $40,000 more than covered $18,000 that he lost. He's still in a profit region. If we took down the $40,000, we subtracted off the $18,000 that he lost, he'd still be worthwhile to operate the business. He'd still be, making more money than he would have made otherwise. He reckons his store is now worth $200,000. That if he had to sell it, invest the proceeds, he could earn himself 8%. Well, 8% on $200,000 is $16,000 a year. Okay, so $16,000 a year plus $18,000 a year. So that's $34,000. Okay, he'd have that would be the opportunity cost of really running a business. And the question is, did he make more profit than the $34,000? He made 40. So 40 less the 34, that means he made $6,000 worth of economic profit in the store. So we got to subtract off those opportunity costs that he missed. So if we had to advise him and say, you should stay in business, the answer would be yes, because he's making more than he could have under the other scenarios. Okay? Okay, so that's that one. Now, I just wanted to give a little bit of a preview to, that's the theory. Okay, we've introduced the theory now in terms of this economic profit versus accounting profit type thing. Now we're going to get into, well, maybe a little bit more theory, but we're going to get into this idea of productivity and the rate of which businesses should produce products in order to make the most possible profit. Okay, so this is the more application side of the unit. If we think about productivity is defined as the ratio of output versus input. How much did you get out of something versus how much did you put into it? And obviously, if you can get more out as a percentage relative to the amount that went in, it's more productive. You squeeze more juice out of the lemon, right? You're squeezing more juice out of the lemon. So it measures how efficiently production inputs such as labor and capital are being used in an economy to produce at a given level of output. One of the common methods of increased productivity is through the division of labor. So early in the Industrial Revolution, it was discovered that we had to measure productivity, or productivity was a really good measure of how well the business was doing. And so we took this ratio of output versus input. And a lot of people looked at it. And one of the first people that looked at it, one of the most famous people that looked at it was Henry Ford. Henry Ford was making automobiles. And what Henry really discovered was not the car. Henry did not invent the automobile. Henry invented the process for making the automobile, or a productive process for making the automobile, okay? If we look at the Ford assembly line that we had in 1912, 1919, here's a Model T coming down an assembly line. Now, there was no such thing as an assembly line before Henry Ford. Cars used to be made by craftsmen, and I say men because it was all men, that would produce the car from nothing to the car. They did everything. They had a lot of skill. Obviously, you needed a lot of skill to take something that was nothing and make a car out of it. Okay? And cars were very expensive because of that, because the people that made them were very few. There were very few craftsmen that made these things. And when they made them, they were all sort of unique. As I made my first car, I changed it a little bit on my second car and on my third one, and so on. Ford said, well, what we need to do is we need to find a way to make cars quickly, easily, and dumb it down. The assembly line was what came out of that. And what they did with the assembly line is they allowed unskilled workers, okay? You did not have to have a great deal of skill in order to build one of these cars, because your job was broken into a very, very, very teeny role. So let's assume that your job is to put the tires on the car. In fact, your job is to put the front right tire on the car. There's other three people that put on the other tires. Your job is just that tire. The assumption is that those people will get very good at putting that tire on the car because they do it so often. Another bit of assumption is that all the tires are exactly the same. Interchangeable parts. Okay? So if you look at these cars on this assembly line in the picture here, all of the tires are identical. And that means you can make copies, like making a photocopy. You can make copies very, very quickly. And in fact, it proved to be better because if you broke a tire, it's easy to replace the tire. You don't have to go back to the craftsman to build you a new tire. The tire is the same on every car, so they can produce lots and lots of examples of tires and lots of spare parts. What this became known of from an economics point of view was the concept of division of labor. And what we did is we took the labor, we employed a lot of people. There were a lot of people on this assembly line. There was just one craftsman before. Okay? there were a lot of people, but those people weren't skilled. They knew basically their job, and that was it. And what was found is that with the division of labor, you could make a lot more cars. And you could, as a result, get the cost of the car down. In fact, Henry got the cost of the car down so much that the people working in the factories could buy the cars, which was the real genius of his operation. So this then really intrigued economists who put some sort of numbers around the concept in order to demonstrate the value of this idea of the division of labor that Henry Ford really pioneered. So here, for example, is a little bit of a demonstration of how the division of labor works in order to reduce costs, okay? It is clear that increased production will involve higher total costs. When you make more, it's going to cost you more to make them, right? No problem there. I think that's understandable. Now, the trick is, common sense indicates that if more inputs are added to the production process, more output will be obtained. But the trick is, the cost per unit will drop. So if we look at our units of labor, so let's assume that the scenario here is we're adding people. So we start off with no people and then we hire one. Okay, we hire one people. One person can produce 4 units a day, a week, doesn't matter, over a period of time. One person can produce 4. What if we hired a second person? Let's bring on a second person. Look at this. Now we're producing 16. Why is that? Why is it that we went from 4, and intuitively we would think, well, if we hired 2 people, we should only get 8, 4 plus 4, right? If one person can make 4, you would think 2 people can make 8. But in fact, 2 people can make 16. Well, the reason is that the division of labor allows people to specialize, right? So they know their job really well. It allows you to put in specialized tools so that you have a particular piece of equipment that can do the job very easily. And the fact is that 2 people can help one another. So the trick is that as you add more, the idea is that they help one another and we get productivity increased. So this is demonstrating here very clearly a big productivity jump. 4 times as much is coming out of 2 people than what came out of 1 person. Now, let's add a third person. Now, as we add a third person, we're getting an increased amount, no doubt. But did it jump? Yes. Well, it was 16 to 36. So what's that? We doubled it again and a little more than doubled it. Here it was 4 times. We doubled it. So what we're noticing is that, yeah, it's still going up, but it's not going up at the same extreme rate that it was at the beginning. In fact, if we look at it, we keep adding people. It keeps going up, no doubt. At right up to here, it keeps going up. And then it levels off for some reason, and we don't know why. Well, why is that happening? Well, if we think about cooks in the kitchen, you know, the too many cooks in the kitchen scenario, you can imagine that labor is not the only resource that's built into the process. It's labor, land, capital, enterprise. So maybe we can adjust labor, but can we adjust the amount of land? How many parts are there for those cars? How many, can we adjust capital? How many tires are being made? How many motors are being made? So what we're doing is we're finding, yeah, we can increase labor, but the other factors of production aren't really increasing. And as a result, that constrains us, right? So what we end up doing is we notice that this rises very quick, and then it starts to peter out in terms of the benefit. And in fact, the benefit will probably be negative after there's too many people because it's hard to coordinate, there's not enough parts, these sorts of things run into some problems. So we see total product goes up, peaks, and may drop. We've looked at this concept of marginal analysis before. All marginal means is what's the difference between one and the other. So the marginal analysis here, we went from 0 to 4, the difference is 4. We went from 4 to 16, the difference is 12. We went from 16 to 36, the difference is 20, and so on. So using the marginal analysis, we can see that, you know, we increased by 4, we increased by 12, we increased by 20, we increased by 24, we increased by 15. So we notice that marginal goes up, 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 up to peaks and then starts to decrease. Okay, so the additional amount. So we notice that there's some peaking. That same scenario that happened here in the total product happens here in the marginal product. We also can calculate our average product, which is really the total product divided by the output. So here we've got 4 divided by 1, 8 divided by, 16 divided by 2, 4 divided by 1, 16 divided by 2, 36 divided by 3, and so on to get you the average. And we'll also notice that similar thing happens to the average. It goes up, peaks, and comes back down again. And we can see then that there's some takeaways from this. As we add more units of labor, productivity goes up to a point. The total product goes up to a point. The marginal product goes up to a point, and the average product goes up to a point. If we ask ourselves, then what should we do? What level of production should we produce at? We need to figure out, well, is it total product we want to maximize? Is it marginal product we want to maximize? Or is it average product we want to maximize? That's really the questions that are being asked here in terms of it. So the advantages of division of labor should become pretty obvious, as Henry Ford has proven out. You know, we see that as workers get added, productivity of worker goes up to a point. Adam Smith saw 5 distinct reasons. Adam Smith is the father of modern-day capitalism. Okay, saw 5 distinct reasons. He called it the productive power of division of labor. The enhanced ability to fit the best person to the right job is one of the things. Increased dexterity achieved by the best worker becomes specialized in performing a single operation. In other words, you keep it simple, stupid. The time saved when workers do not have to change tools or switch machines. Again, machine specialization. The time saved when otherwise that would be lost moving from one operation to another. I just stand by the front right wheel. That's my job. I don't have to move around. The machine specialization can be developed around specific discrete operations. In other words, you can have a particular machine to do a particular task. When productivity for worker begins to drop, we say that we're experiencing what's called diminishing returns. In other words, we don't want to be into a point of diminishing returns where we have too many workers and not enough production, or production is not going up anymore. This is known as the law of diminishing returns. And effectively, the law of diminishing returns states that as more and more units of a variable, such as labor, is added to the production process, at some point, the resulting increase in output, which is your marginal product, begins to decrease, assuming that at least one other input is fixed. In other words, not all of the units of production, all the factors of production, land, labor, capital, enterprise, are changing. It's just one. And as a result, even though labor is getting bigger, the other ones are constant. And because they're constant, we can't continue to escalate production. You know, we're going to be limited in the amount of capital, limited in the amount of land, whatever. Our resources are really constrained. And this is simply a factor of diminishing returns. We call that diminishing returns. Okay, so what we're going to look at next is the graphing of this, and then we're going to try out some of the graphs. We're going to actually do that. We're going to look at, then we're going to switch to the cost side. So all we looked at is the actual physical production so far, but in the next class, we're going to look at that plus the cost size and calculating the costs.